The US stock market is more than 100% overvalued and is reaching levels that we've only seen one time in recorded history. In this video, we're going to dive into this chart. I'm going to explain to you exactly what it's measuring, why it's important, and what it means for the future of your stock market investments. Coming up. Hey there, it's good to see you. If this is our first time meeting, my name is Steven Spicer, and my goal is to help you build your rapidly growing, highly diversified net worth one video at a time. And this video, in particular, is a part of a larger mini-series devoted to analyzing and really understanding the many signs of an imminent crash, and then ultimately using this knowledge to help you prepare your portfolio, crash or no. To start from the beginning of this series, click on the link right at the top of the description below and stick around until the end. I've created a resource that will help you crash-proof your portfolio. Last time we talked about the Tobin-Q ratio, and although this chart looks somewhat similar in that the market clearly appears to be overvalued, these two are tracking very different things. This chart is tracking the cyclically adjusted price to earnings, or CAPE ratio, of the S&P 500. Now, if you know what the CAPE ratio is, you're welcome to go down to the description right now and find the timestamps to jump ahead of this explanation. The CAPE ratio was popularized by Nobel laureate Robert Shiller. Thus, it's also commonly known as the Shiller PE. To best understand the Shiller PE, you need to understand the price to earnings ratio first. If you don't already, then pause this video and watch this one in another tab to get up to speed. Check the description at this timestamp for the link. Now, assuming you understand how the PE ratio is calculated and what it can tell you, we can proceed. The cyclically adjusted version of this ratio was initially proposed by Benjamin Graham and David Dodd in their seminal 1934 book, Security Analysis. Their idea was to average companies' earnings, the denominator of this equation, over a longer period of time in order to reduce the volatility. Well, the Shiller PE does that over a 10-year period for the S&P 500 as a whole. The ratio currently sits above 33, a level only surpassed once in history on the dramatic ride up to the tech bubble peak. Not in 2007 and not even in 1929 did the market see levels this high. And this ratio's historical average is around 16.5. For the S&P 500 CAPE ratio to come down to normal levels, one of two things would have to happen. One, the earnings of the S&P 500 composite companies will have to go up a lot without also driving up the price of the market as a whole. Or two, the price of the S&P 500 itself will have to drop substantially. It's a depressing hypothetical, really. A reversion to the historical mean, which is exactly what happened in 2009, but we weren't immediately coming from quite so high, today would constitute a drop of more than 50%. And just for fun, a return to the 1920 historical low, around 5, would constitute a cataclysmic 86% crash. Of course, I'm not suggesting this will happen. If you think that I am, then you need to go back to the first video of this series. But I'm also not naive enough to rule anything out as a possibility. I'm reminded of a Robert Shiller interview conducted by commentator George Will shortly before the ultimate peak of the tech bubble. Will made Shiller look bad as he pointed to the fact that Shiller had been publicly pronouncing the stock market to be overvalued for years by that point. And during that time, the market had continued to climb. It had doubled, in fact. He seemed to think that that made Shiller's warnings foolish, that people shouldn't have paid him any mind. What do you think? Obviously, with hindsight, that question is probably a little bit easier than it would have been in that moment, because ultimately Shiller was validated and appeared remarkably prescient as the NASDAQ cratered 78% from its peak. All I know is that I want to be as prepared as possible no matter what happens to the market, a continued bull or a devastating bear. That's my ultimate goal with this, to help you crash-proof your assets, your life savings. In fact, I created a crash-proof resource guide and checklist that you can download at crashproofguide.com. It'll be a living, growing resource that you can keep coming back to as you continue to strengthen different areas of your portfolio and as we continue to find more resources to help you along the way. Again, go to crashproofguide.com if you're interested and if you haven't already downloaded yours. Now, to be fair, there are some modern day criticisms with this ratio. The most valid, in my opinion, being the fact that over this time period, we've adjusted the generally accepted accounting principles by which companies report their earnings. Obviously, this could impact and potentially elevate this ratio. Now, if you learned something today, anything, then leave me a like and share this video with some friends who could stand to benefit from this critical knowledge. And hopefully you can see the value that comes with being a member of this community. So if you haven't already, don't forget to subscribe and click the bell. I look forward to seeing you in the next video. Take care.